What happens if Israel attacks Iran? The global economy could react faster than the missiles. Let's think like economists, not spectators. Wars reshape supply chains before headlines even settle. The Middle East is not just geography. It's the heartbeat of global energy markets. The first market to panic would be oil, because supply fear moves faster than production reality. Traders don't wait for shortages. They price risk instantly, sometimes within seconds of breaking news. If conflict spreads, investors worry tankers may stop moving safely through key routes. One critical choke point is the Strait of Hormuz, carrying enormous global oil traffic daily. If that passage closes, markets wouldn't whisper. They would scream through price spikes. Shipping would reroute immediately, turning simple deliveries into long, expensive global detours. Longer routes mean more fuel, higher freight rates, and ultimately more expensive goods everywhere. That's how a regional war becomes global inflation within weeks. Natural gas often follows oil because energy markets move like connected vessels. When gas rises, electricity costs rise, and governments scramble for alternatives. That's when coal quietly re-enters the story as the backup fuel nobody expected. Coal markets move slower, but they respond to persistent energy shortages. Meanwhile, shipping companies benefit from longer routes and higher charter rates. War can be destructive, yet strangely profitable for logistics providers. Insurance companies also raise premiums, turning risk into revenue. Now think about investors. Where do they run when uncertainty rises? Historically, they run toward gold, the oldest refuge in times of geopolitical fear. Gold doesn't produce energy, but produces psychological safety. The longer conflict lasts, the stronger gold's appeal becomes. Now imagine escalation. What if allies begin choosing sides? If the United States joins militarily, markets may reprice risk across every commodity. Oil could surge again because supply fears multiply with wider conflict zones. Defense industries might rally, reflecting expectations of prolonged military spending. Airlines, however, suffer as fuel costs climb and travel demand weakens. That's how wars rotate capital between sectors rather than destroy it entirely. Over months, governments may release strategic reserves to calm markets temporarily. But reserves treat symptoms, not structural supply risk. If uncertainty persists, companies invest in new drilling and mining projects. That's how high prices today create supply tomorrow. Some governments instead accelerate renewable energy to escape geopolitical vulnerability. Conflict often speeds energy transitions more than environmental agreements do. Meanwhile, emerging economies feel the pain first through fuel import bills. That pressure can weaken currencies and raise domestic inflation. Food prices may follow as transport and fertilizer costs climb. Notice how energy shocks ripple outward into nearly every industry. This is why economists watch shipping routes as closely as battlefields. Markets often react to logistics before they react to politics. Over time, alliances may shift as countries search for safer suppliers. New trade blocs form when energy security becomes national survival. If conflict drags on years, commodities may enter a sustained bull cycle. Yet extremely high energy prices can slow economies and reduce demand. Markets constantly balance fear-driven spikes with demand-driven corrections. So investors must ask not only what happened, but how long uncertainty lasts. Short wars shock prices. Long wars reshape industries. That's the real lesson. Commodities move with expectations, not just events. Understanding routes, supply chains, and psychology makes investors calmer than headlines. So if conflict erupts, remember, markets don't wait for history. They price the future instantly.